Good morning, ladies and gentlemen. I am Janice, the moderator for this conference. Welcome to the Q3 FY22 earnings conference call of Motilal Oswal Financial Services Limited. We have with us today Mr. Ramdev Agarwal, Chairman, Mr. Motilal Oswal, MD and CEO, Mr. Naveen Agarwal, Director and AMC CEO, Mr. Ajay Menon, CEO, Broking and Distribution, Mr. Arvind Hali, CEO, Housing Finance, Mr. Shaliprada Shah, Chief Financial Officer, Mr. Rakesh Shinde, Investor Relations. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now invite Mr. Naveen Agarwal to make his opening remarks. Thank you, and over to you, sir.
Good morning, everybody. It is my pleasure to welcome all of you once again to the Motilal Oswal Financial Services earnings call for the third quarter and the 9 months ended 31st of December 2021. I wish all of you a very happy new year, and we hope that each one of you and your families are safe and in good health. For the third quarter, we've reported operating profit after tax growth of 92% year-on-year at 2.33 billion. This is the highest ever quarterly operating profit for the firm. For 9 months, we've reported a profit after tax growth of 25% at 9.96 billion. And these profits, excluding gains on investment, grew by 58% year-on-year to 5.49 billion. This is the highest ever 9-month operating profit as well. Core business was robust with capital market profit after tax up by 99% year-on-year and 22% quarter-on-quarter. Asset and wealth business saw a 61% YOY growth led by 38% growth in the asset management profits, 186% growth in the wealth management profits, and 46% growth in the private equity business profits. Consolidated net worth touched all-time high at 53.8 billion. Net debt is 46 billion. Excluding home finance, we are a net cash company, net of our equity investments. Return on equity for the 9-month period stood at 31%. The board declared highest ever interim dividend of 7 rupees per share. We are also happy to inform you that during the quarter we've onboarded digital head Mr. Nipun Nirvani, who's ex-Amazon and McKinsey in the broking and distribution business. We've also onboarded Mr. P.H. Ravi Kumar, who's ex-Vastu, Utkarsh, ICICI Bank, on our housing finance, MO Home Finance board. Turning to the key highlights business-wise, for our capital markets business, we continue to see strong growth of 69% YOY and 20% quarter-on-quarter in our revenues, led by strong traction in client addition, 92% growth in average daily turnover, with mix favoring high-yielding cash delivery volumes. We witnessed strong growth in active clients and traction in our distribution business as well. We continue to make investments in augmenting our talent pool and our distribution network, and also continue to benefit from consolidation in the broking business. We've also started adding talent on the digital side to revamp our digital journey. In asset management business, we witnessed lifetime high markets, which have in turn lifted our AUM to our highest ever. Our mutual fund gross sales and SIPs also gained traction, and AIF continue to receive encouraging response among high net worth individuals. IREF 5, which is a real estate fund 5th series, has raised 10.9 billion. We've also launched our largest ever private equity growth fund, India Business Excellence Fund Series 4, with a target size of 40 billion rupees. We're happy to inform you that we've received a tremendous response to the launch of this fund and achieved first close of 27 billion rupees. As far as the home finance business is concerned, we witnessed strong pickup in disbursements, traction in our logins and sanction pipeline, and a meaningful expansion in sales force to ramp up our disbursements in the coming quarters. Finally, sharp reduction in cost of funds that we have been seeing for the last few quarters continued during the current quarter, and that was a big driver for our margin expansion in this business. Further, with a series of rating upgrades we've received, we believe that liability franchise, both in terms of availability and cost of funds, is only likely to get better. I will now deep dive into individual businesses, starting with the capital market franchise, comprising of the retail broking, institutional equities, and investment banking business. Our revenues for this segment were at 7.26 billion, up by 19% quarter-on-quarter and 68% year-on-year. They were at 18.4 billion for the 9-month period, which is up by 54% year-on-year. Our capital markets business contributed to 55% of the consolidated revenues of the entire firm. Profits grew by 22% quarter-on-quarter, doubled on a year-on-year basis at 1.5 billion rupees during the third quarter. And for the 9-month period, they were up 64% at 3.5 billion rupees, led by healthy volume growth of 92% year-on-year. Within the retail broking and distribution business, we witnessed strong traction in new client additions, led by franchisee as well as our own brand channel. A total of 640,000 clients were acquired in the 9-month period, which is up by 62% year-on-year. NSE active clients have also registered a 59% year-on-year growth at 790,000 as of December of 2021.
Members of the management, can we open the call for a Q&A session now? Excuse me, members of the management, this is the operator. Are you able to hear me? Members of the management, this is the operator. Could you please confirm if you could hear me? Ladies and gentlemen, I would request you all to please stay online while we check the connection for the management. Thank you. Ladies and gentlemen, thank you for patiently holding the line. We have the management reconnected. Over to you all, sir. You may please go ahead.
I'm not sure where we got disconnected, but I'm still going to start with the deep dive into our individual businesses, starting with the capital market businesses. No, they said 1 minute before. Yeah, so starting with the capital markets business, it comprises of the retail broking, institutional equities, and the investment banking business. Revenues for the capital market franchise were at 7.26 billion, up by 20% year-on-year, up by 70%, up by 20% quarter-on-quarter, and 70% year-on-year. And they were at 18.4 billion rupees in the 9-month period, which is up by over 50% year-on-year. The capital market businesses contributed to 55% of the consolidated revenues. In terms of profits, the numbers grew by 22% quarter-on-quarter, 99% year-on-year at 1.5 billion rupees. And for the 9-month period, we're at 3.46 billion rupees, up by 64% year-on-year. In retail broking and distribution, we witnessed strong traction in new client addition, led by both the franchisee as well as captive branch channel. A total of 640,000 clients were acquired in the 9-month period, which is up by 62% year-on-year. Our NSE active clients have also registered a 59% year-on-year growth at 790,000 as of December 21. In terms of the distribution AUM, just of the retail broking business, ex the wealth business, it was up by 39% year-on-year at 166 billion as of December 21. This is with only 16% of the 2.6 million client base tapped, and we expect continued traction as we cross-sell to more clients and cross-sell more number of products per client. In institutional broking business, the team continues to win big in Asia Money poll. Once again, like in 2020, even in 2021, we were ranked number one best local brokerage house, best sales, best execution, and best corporate access. Strong improvement in domestic rankings with top 3 clients have been retained in most clients, which in turn drove our revenues and profits. This in turn has been a result of differentiated research products spanning 250 companies and over 20 sectors. In our investment banking business, we participated in 3 deals during the quarter, but importantly, we have a strong pipeline of signed IPO mandates which have started entering the market from the fourth quarter onwards, which in turn is expected to drive stronger traction in revenues and profitability in the coming quarters. Turning to the asset and wealth management business, our asset management business AUM spanning mutual funds, PMS and AIF stood at 507 billion rupees, up by 20% year-on-year. We witnessed a strong growth in PAT to 528 million, which is up by 27% quarter-on-quarter and up by 38% year-on-year. For the 9-month period, the asset management business profit stood at 1.3 billion, which is up by 43% on a year-on-year basis. Our equity mutual fund AUM stood at 310 billion, which is 1.5% of the industry mutual fund equity AUM of 21 trillion. We have seen improvement in performance of several products. Our gross sales and net sales have started improving. We've also witnessed favorable response towards our alternate asset offering, including AIF, and expect continued flows in these strategies. Our share of alternate assets comprising of PMS and AIF stood at 37%. We've added 340,000 SIPs in the 9-month period, which is up by 57% year-on-year. Our new SIP market share stood at 1.7% in the 9-month period. Our private equity business has fee-earning AUM of 98 billion rupees across 3 growth capital private equity funds and 4 real estate funds. In third quarter, our revenue stood at 323 million, PAT at 100 million. Our first private equity growth fund delivered XIRR of 26% plus. Average IRR on exited investments in real estate funds stood at 21% plus. Our 5th series real estate fund has raised 10.9 billion rupees. Our private equity business launched the 4th series of the growth capital fund with a target size of 40 billion rupees and has already achieved the first close of 27 billion rupees. Within the wealth management business, our AUMs were at 342 billion rupees as of December 21, up by 50% year-on-year. Revenues were at 593 million for the quarter, up by 80% year-on-year, led by strong net sales of 18.4 million in the third quarter. Our yields for this business stood at 73 basis points. Our RM count stood at 139. Our trail revenues predominantly cover our fixed costs, and strong operating leverage is visible, led by improvement in RM productivity. We continue to invest in this business by adding RMs. Overall, asset and wealth management business revenues were at 2.59 billion rupees, up by 37% year-on-year, and at 6.83 billion rupees for the 9-month period. These businesses contributed to 20% of the consolidated revenues and 21% of the consolidated profits. Turning to the home finance business, we reported a profit after tax of 188 million in the third quarter, which is up by 300% year-on-year. For the 9-month period, we reported a profit of 473 million, up by 121% year-on-year. Our NIIs grew by 10% year-on-year. NIMs expanded to 7.6% in the third quarter. Yield on advances stood at 14%. Cost of funds at 8.1%, down by 85 basis points, resulting in an expansion in spread to 5.9%, up by 65 basis points. We've raised 6 billion rupees in the 9-month period at an average cost of 7.06% versus our overall cost of funds of 8.3%. And this number is expected to trend lower in the coming quarters, led by the latest rating upgrade of the MO Home Finance Company. Disbursements during the third quarter stood at 1.9 billion, up by 19% quarter-on-quarter. We believe that the business is geared up for stronger growth in disbursements. with the sales force expansion currently underway. In the third quarter, our provisions were higher due to new NPA recognition norms by RBI, which led to rise in GNPA by 120 basis points quarter-on-quarter to 3.4%. Excluding this new norm, GNPA would have been 1.3%. However, our collection efficiency in December has reached about 100%. Our net gearing still stands at just 2.4 times, and Tier 1 capital adequacy remains robust at 47%. Finally, turning to our fund-based activities, which includes commitment to our asset management, private equity, real estate products, our fund-based investments have registered gains of 61 million in the third quarter and 3.6 billion in the 9-month period. Total quoted equity investments, including unrealized gains, stood at 26.9 billion as of 9-month period. Our cumulative XIRR on these investments is about 18% since inception. Our total equity investments, including alternate funds, stood at 37.6 billion rupees as of December 21, and the XIRR on our private equity real estate investments have been a compounded 33% per annum. To sum up, our last financial year was a landmark year for us with highest ever revenues and profits. This year, ending March 22, we are continuing to witness similar trend as we deliver highest ever quarterly profit as well as a 9-month operating profit. Our retail broking business, which is our cash cow, has achieved new highs on various parameters, benefiting from the industry consolidation. Our institutional business continues to be ranked number 1 local brokerage house for the second year in a row. Our strategy to invest business profits in our own equity investment products led to highest ever profits, and as a result, our net worth touched new highs as well. Moreover, our strategy to diversify our business model towards linear source of earnings continue to deliver results. Our asset management business is likely to gain from the process-driven investing and its niche offerings. Our wealth management business has delivered stellar performance in the 9-month period and is on its way to achieve scale in this business. Private equity business has delivered on both successful exits of its investments as well as fundraise of its largest ever fund. And finally, our housing finance business is geared for profitable growth. Each of these 7 businesses offer adequate headroom to growth. We are now open for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Karthik Sahani from Myra Asset Management. Please go ahead.
Hello, sir. Hi. Good morning. 2 questions, sir. First of all, I would like to know the size of your MTF book. And secondly, considering the digital push, I would want to know what is your target for the overall cost to income. Currently, I think it is at around 51%. Thank you.
Yes. Yeah, hi. So our actually MTF book, the total funding book in our retail broking business stands at 2,100 crores at the end of the quarter. Okay. And in terms of the cost to income, overall, if you see cost to income for us has been coming down because if you see there is a margin expansion which has happened during this quarter as well. So our EBITDA margins are at 41%, and certainly we are seeing the benefit of this operating leverage playing out because not only brokerage has risen, but even other revenues continue to contribute to the operating leverage, which is the distribution income, the advisory revenues, and the interest revenues as well. So while we have invested also heavily last year as well as this year in the manpower and technology costs, we continue to do so out of our profits. However, given the operating leverage improvement year on year, but definitely we would see the cost to income lowering every year.
So, sir, is there any target figure for this?
So, as such, we don't have that target number, but we can assume safely 35% over EBITDA margins, which we have been consistently having and improving over that as well.
Okay, sir. Thank you. Understood. All the best.
Thank you. The next question is from the line of Hitesh Gulati from Haitong Securities. Please go ahead.
Yeah, thank you, sir, for giving me the opportunity, and congratulations for strong operating profit. But I just wanted to know, on the broking business, we have had this change in norms for IPO related to IPO financing. So what has been the kind of impact, positive impact that we have had in Q3 and maybe we'll have in Q4? If you could quantify that, and what will happen post Q4 March? How do you see that kind of impacting our broking revenues and profits there?
Yeah, Hitesh, so basically, what you are asking is about the IPO financing spreads that have been there in the profitability, right?
Yes, sir. So basically, from what I understand is that because of the new lending norms for NBFCs, some of the kind of IPOs are getting preponed in the earlier quarters, right? So we would have seen some benefit of that, right? So if you could just quantify that benefit and how it will change post Q4 March.
Yeah. So as far as the IPO spreads are concerned, so during the quarter, we had a spread of about 40 crores included in our profitability on account of the IPO financing that we have done. As far as the new regulatory norms that have come, so suddenly it has an impact on the HNI piece, because the HNI piece where they say by doing a draw of lots, so it would have some bit of impact, but I think the market would regularize that over a period of time, because what we have seen, any new regulatory framework coming in would get settled in a span of 2 to 3 quarters. So maybe there could be some bit of impact on account of that from April 1. However, we will see that normalizing in due course because of the regulatory change.
Sure, sir. So 146 crore broking profit, 40 crore is IPO financing. Can we, is my understanding correct here?
Sorry, I said that there is a PBT number of 40 crores included in the broking profits in Q3 of this quarter, as far as IPO financing activity is concerned.
Okay, sure, sir. And just one question on cash ADTO. So if you look at Q1, it's almost flattish. So anything to read into that, sir?
Sorry, unable to hear your voice clearly. Could you repeat it?
Yes, sir. So I'm talking about cash ADTO.
Yeah.
On cash ADTO on QOQ, we are almost kind of flat, sir. Is that understanding correct, sir? And is there any reason for that?
Yes, that's right. That understanding is correct. We are flattish on a sequential basis in terms of the cash ADTO is concerned. Whereas for the F&O, we have seen improvement in our market share by 20 basis points on a sequential basis.
So any reason for why it's kind of flat? So is that a market trend, or, I mean, in terms of market share, cash market share, would we be flat, or would have we lost some market share there?
We have not lost any market share on the cash market. If you see that the volumes are being shifted towards the derivatives in a big way. So we have maintained our cash market share and increased our market share on the F&O.
Sure, sir. Thank you. That's it from my side.
Yeah.
Thank you. The next question is from the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Yeah. Thanks for the opportunity. Could you comment on, the kind of technology spends we've done this year? Because, the entire operating environment has changed. Volumes have, gone up. Work from home was going on. So what kind of technology spends have we seen this year?
Yeah. In terms of the technology spends in our retail broking and distribution business, we have a spend of averaging about 10 crores per quarter in the course of this financial year.
Okay. And that should continue as we move forward?
Yeah, it would continue. In fact, it has been enhancing year on year because, and this also does not include the people cost. So
right.
People cost is over and above this. So we continue to... Yeah.
Right.
So, we continue to add more talent even on the digital side of our business there, as we have been announcing every quarter on quarter. So this number should keep up looking.
Right. And at a system level, we are seeing incremental demat accounts opening. Demat accounts have doubled, NFOs are doing well, SIP flows. So all the constituents are firing together. Typically, based on our experience and cyclicality, what happens when the cycle turn? Which gets affected the most? Is it, direct investment and incremental investors, then NFOs, then SIPs? What happens when the cycle turns?
Yeah. Hello. Yeah.
Yes,
this
sir.
is Ramdev Agrawal here. Good morning.
Hi, sir. Good morning, sir.
So this is unprecedented cycle because the way I understand, let me tell you, and then
Sure.
you can take question. One is that the Demat accounts, which were for till about 2020 was 40 million, has doubled in next say 24 months. By this thing 21, it is enough 80 million. And my sense is we are headed for 200 million in next 2 to 3 years. 3 years. So this cycle of horizontal expansion of the market, particularly in retail, is going to continue at different paces for next 3 to 4 years. That's my sense. Okay, after that, once the market is expanded, then obviously the cycles will come. But it will be much more shallower, but first market will expand by 2-3x from here. And then of course, but how steep will be correction? We have seen the corrections are there. Volumes will come down and brokerage will come down. But I think we will stabilize at much higher level.
Okay.
And fourth is the consolidation. Consolidation on both sides. From broking side, you are seeing the consolidation of 20%, 15% market share of the top 3-4. Like that, even bigger consolidation will happen on the advisory side, advisory and execution side. That is where we belong. So there also there will be a lot of consolidation, and hence the market in terms of volume might be say 25% for the advisory and 75% by sheer volume will be for the discount broking. But in that 25%, you will see a lot of emergence of consolidation. And so on expanded market, you will have consolidation. We have to only make sure that we are survivors of the consolidation rather than losers of the consolidation.
Right. So this is like what real estate went through in
Same.
7-8 years of super cycle. I think 2004 to 12 or 13. Okay.
But real estate is a physical business. This is a digital business. You don't need more than 2-3 players to cater the whole country. So consolidation, kind of a winner takes it all, is going to happen here.
Sure, that's helpful. And lastly, I think PMS AUM for us has been flat for almost 4 years now. Couple of quarters, we had highlighted there were some performance-related issues which had affected flow. So how is the performance been? And if you could comment market share changes, if any, at our end in this kind of period. Has there been a major loss, major shift? Are we more or less similar in terms of market share? If you could comment on that, it would be helpful.
Yeah, there are a couple of aspects here. First is that because of upfronting being banned on PMS, we've seen a takeoff in the last 1.5 years in AIF. So AIF commitments this year are up by 50% compared to the previous year. Secondly, as far as the PMS is concerned, our flagship next $1 billion opportunity product as of 31st of December was among the best performing product in the category. So in the first phase, we've seen a sharp slowdown in redemption there, and we are hopeful that 2022 should see a very strong pickup in net sales as far as the PMS product is also concerned. So we are looking at continued strong traction in AIF sales. As I mentioned, they are up 50% year on year incrementally, and PMS, where the flagship product is performing in line with the best performing product as of 31st December, and we expect strong traction in that in the calendar year 2022.
Understood. And lastly, on home finance, Maharashtra and Gujarat are 36% of disbursements. So where do we see them settling down? And Delhi and Haryana are 17% of disbursements. So is that a reclassification, or we build that from scratch? in the last few quarters?
So, historically, Maharashtra and Gujarat have been the initial states where we started our business, and almost 50% of our current branches are in Maharashtra and Gujarat. So they have, over a period of time, concentration has reduced, not in terms of the business that they generate, but as a percentage of the overall business, because other states we have started to densify and we have started to increase our penetration in the states like Rajasthan, Tamil Nadu, Karnataka, Andhra Pradesh. Delhi, NCR and Haryana are states that we have just recently launched in the financial year 22. They have just been in operations for the last 8 months, and on an incremental basis, they have been doing pretty well, and therefore, as an overall percentage, they have shown significant contribution. But over a period of time, we expect that Maharashtra and Gujarat will continue to remain about 30% of the overall disbursal on an incremental basis.
Okay. Thank you. All the best. Thank you.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, congratulations on a good performance, and just a couple of questions from my side. First, what are the net sales in asset management for this quarter? Can you divide it in mutual fund, PMS, AIF?
Net sales are 12.7 billion for the quarter, and which is comprising of 2.2 billion on alternates and rest on mutual funds.
No, but so if your the AUM is only going up from sorry, I understood. Yeah, sorry, my bad. And so this time I see that there is an improvement in yields, and the profitability of the business has also improved. So there is a little bit of a margin improvement, and the tax rate is also lower. So can you explain what is actually happening? Because the growth in revenues QOQ is much stronger than the growth in assets.
Basically, if you look at the EBITDA margin of this business, it's really back to the peak margins that we have earned before, because the AUMs have gone up also. So typically, whenever you will see the benefit of mark to market, the benefit of sales, cross sales coming in, there will be strong operating leverage. In fact, so that is something that is the driver of improved profitability. As far as pricing across our products are concerned, we have never competed on pricing for any of our products. So really the only yield drop that you would have seen for our products in the last 3 years were driven by two regulatory changes, where first the direct TER was equated with the intermediated TER, which was a big hit for us, and the second was there was a size linked AUM yield that was defined by the regulator. So these two regulatory changes were the only two drivers to yield correction, right? The other important driver to yield correction has been a mix change in favor of passive. So those will give you some color on the yield on a like-to-like basis for an active mutual fund or a PMS or an AIF or a passive fund. The yields are best in class and stable. And so as you see gross sales and mark-to-market impact, costs are likely to be sticky, and hence you will see operating leverage coming through.
Right, but what I meant was actually that your yields have improved in this quarter, right? Because the AUM has gone up only like 2% QOQ, but your revenue is up 14% QOQ. So and actually PMS in the mix has not gone up. Is actually down on a closing basis. So is there something else that's happening there? Am I missing something here?
Yeah, I'd urge you to avoid focusing too much on quarter, because if you look at the yields in the third quarter, it is 75 basis points for the AMC. In the same quarter last year, it was 78 basis points, so down by 3 basis points. But in the second quarter, it was 72 basis points. So you will have, on a quarter-on-quarter basis, sometimes even adjustments that are being made, to the mutual fund yields to account for some overflow of expenses, etc. So maybe, that may lead to 2-3 basis points up and down on a quarter-on-quarter basis.
Understood. So it's more because of that, you would say then. Okay. Got it. Yeah, that's it from my side. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Good morning. I have a bunch of questions only on the home finance business. There are about four to five questions. Shall I just ask them sequentially, if that's okay? I'll just ask them to go right ahead. Would that be okay?
Yeah, that's perfect.
Okay, so these refer to slides 37 to 40. I can understand the NPA increase due to the change in RBI norms, but it's not actually, if you see on a like-to-like comparison, it's actually decreased. Does this change in RBI norms actually mean that your customer segment delays are possible, but eventually the money comes back, that the credit losses will be very low? That's question number one. Slide 37, we see entry of securitization. So is the company exploring alternative models like coordination or loan sell downs to ensure growth in the future, given the fact that most of the loans seem to be priority sector eligible? The third question is, there is incredible diversity in terms of your customer mix, product mix, etc. So is there any segment where you feel that that there is a particular risk where you need careful watching, or is this the way that the company is going to be in the future, where it is going to be spread across various segments? Because I've also noticed that a subsequent slide you've given FOIR and LTV. Is that a very critical part of doing home finance business of your kind? And the last question is in the cost to income, which has been in the 35 to 40% range throughout. With increasing operating leverage, your debt equity is also extremely low. Do you expect that this will come down sharply in the future to give better quality pre-provision profits? Thank you.
Yeah. So to take your first question on NPA and the impact of the regulation, the recent regulations of Reserve Bank of India. So the segment in which we operate, which is economically weaker and low income group, naturally the income earning has been impacted because of the COVID, as well as the fact that the customer segment earns over a period of the month, and then therefore earlier the way the things were operating in terms of classification of NPA, we used to get a little more time to collect the money. Now on the day of the billing cycle itself, if the customer has crossed 90 DPD, so therefore you have to classify it as an NPA. However, we believe that as the economy is improving and the external environment is showing resilience, and there are obviously improvements, the normalization of the sudden increase in the NPA will happen, and we are already seeing that in the last 45 days, that our collection efficiencies have been almost touching 100% now. So we believe that while there has been a spurt in terms of NPA because of the regulation, which was a sort of a sudden act from the regulators, now we are focusing on these cases, and we believe that the problem is that we have to actually normalize them. It's not that one or two EMIs have to be collected as in case of the earlier regime, whereby collecting one or two EMIs you could basically roll back the NPAs. Now you have to collect all the outstanding installments. So that makes it a little tough, but I think over a period of time, given the improvement in economy, we should be in a position to reduce the NPAs. As far as securitization and direct assignment is concerned, I think it is an integral part of our strategy in terms of diversification of our liabilities, and we will definitely evaluate securitization and direct assignment of the portfolio. For any housing finance company, I think it's a very important liability strategy. As far as co-lending is concerned, we are evaluating it at this point of time. We would like to build our book rather than to go for co-lending opportunities, because our cost of funds is very good, and therefore at this point of time we would rather like to build our own books rather than to go for a co-lending. But at some stage it might make sense for us to look into that. As far as diversification of the customer mix is concerned, I think that largely we have a very balanced mix between salaried and self-employed customers. We are almost 55% salaried and 45% self-employed. Over a period of time, the mix may slightly reverse more in favor of the self-employed segment. But on an overall basis, I think it would be a very marginal difference. FOIR and LTV are basically determinants of the risk that you are taking, one on the underlying security and second on the cash flows of the customer. And these are very critical parameters for any lending business, not just housing finance business as such. So if you look at our numbers, they are pretty much very conservative and pretty much in control. 48% of FOIR and I think 55% on the LTV. So I think we have enough customer equity in the loans, and we are not very aggressive in terms of over leveraging the customer. As far as cost income is concerned, because we are in the build-up phase, and we will see a kind of increase in the near future. There might be a marginal increase, but over a period of time, we believe that it will come down as there would be increase in the revenues and costs will stabilize. Most of our investment will obviously go in terms of hiring at the bottom of the pyramid. So while the numbers will be large, but the per person cost would be relatively lower. And as they become more and more productive, we will see that cost income ratio will reduce. 60% of the cost anyways is the manpower cost. We will also invest in technology, and we are already fairly well digitized. And there are various projects which we keep doing in order to improve the throughput and reduce the cost, and also manage the risk through technology intervention.
So thank you. If I can just ask a follow-up question, and I know I've taken a lot of time. The question is in terms of the ticket sizes also. I mean, even there's a significant spread. Would you go for a larger ticket size so that you can get better, quicker AUM growth?
So we are largely focused. While we cater to EWS and LIG, but a large part of our incremental business is completely focused on low income group, which is basically the customer segment between monthly annual household income of 3 lakhs to 6 lakhs. And therefore, our average ticket size, which is currently at about 9 lakhs, would tend to increase marginally, maybe to about 11 to 12 lakhs. We do source business with a maximum ticket size of 40 lakhs, but on an average basis in home loans, it would remain range bound between 10 to 12 lakhs.
Thank you so much, and wish you all the best.
Thank you. The next question is from the line of Shaleen Seth from Tiers Fund Management. Please go ahead.
Good afternoon, gentlemen. Congratulations on these great set of numbers. My question is related to the market share we have in the equity segment. So we've been in the company since quite years. We've been there for the past 8 odd years now. And 2016 was the year probably when we marked 2% market share. And for the past 6-7 years, we have stayed put with 2%. So what trend do we really understand this to be going? And I do understand there's cutthroat competition at the end, but what do we perceive for the next 5-7 years, considering that we are actually dealing with the best discount brokers now?
So if you see, actually, our cash market share has continued to rise in, whereas F&O market share also, if we see, has been gradually improving. So it is also a function of market mix, where if the F&O volumes dominate, definitely the overall mix and the overall market share would look same. However, the cash market share continues to rise because we are at about 6.3% cash market share. And every year, this market share number, we are targeting to improve by between about 50 to 70 basis points, which has been the trend if you see over last 4 to 5 years as well for our market share.
Okay, right. So my second question will be on the wealth management business. So there was a significant growth that we had witnessed in this third quarter. I just wanted to understand, is this because of, is this a transactional revenue or this is the annuity income that we perceive will grow forward?
Predominantly led by the annuity revenue. There's no lumpy upfronting or transactional revenues. Obviously, broking business is also a part of the overall, broking for these clients is also a part of the overall revenues. And so basically, you've seen buoyancy in the overall broking revenues as well. We have a slide that we put out, slide number 34, which shows you that in the third quarter, the recurring revenues as a proportion of total revenues went up from 43% in the second quarter to 47% in the third quarter.
All right, I see it. That's very helpful. Thank you very much.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir. So my first question is, on a home finance, what is the average loan tenure?
So, as far as the maximum loan tenure is concerned, we go up to 25 years, but as far as home loan is concerned, but on an average basis, typically what we have seen that actuarial life would be about around 8 to 10 years.
Okay. And so my second question is, given we are doubling our headcounts in Aspire, so what disbursements are we targeting in next 2 years?
Sorry, I missed you.
Sure. So we are doubling our headcount in Aspire. So what disbursements are we targeting for the next 2 years?
Sorry, just to correct you, our housing finance company is known as Motilal Oswal Home Finance. And just to come back to your question on disbursals, so as we speak today, we have, as we mentioned, about 1.9 billion disbursal rupees of the last quarter, and it has been an improvement on about 20% on a quarter-to-quarter basis and about 280% on year-to-year basis. We feel that in next about 5 years, balance sheet from current 3,500 crores will double to about 7,000 to 8,000 crores. That's what. And the idea is to increase our disbursals. We have added a sales force, also by virtue of a slight improvement in the ticket size and by virtue of increasing the productivity of the incremental sales force, we should be able to reach about 100 crores of disbursals in the next financial year, and then from there on, keep on increasing. Some locations will also be added, branches will be added. We have obviously a plan to reach double our balance sheet in the next 5 years.
Okay. And so my last question, what would be our credit cost guidance for next year?
About 1%.
1%?
Currently, it is obviously elevated because of various impacts, but next year we want to keep it within 1%.
Okay, got it. No problem, sir. No problem. Thank you very much.
Thank you. The next question is from the line of Vibha Batra from Fair Connect. Please go ahead.
Yeah, my question is on the housing finance subsidiary. At what level of gearing would you like to run the business on a steady state basis? And second is, would you be looking at an IPO for the company, and what would be the time frame or asset base at which you would like to look at the IPO?
Yeah. As far as leverage is concerned, so currently the leverage is below 2.5 times, and so between 5 to 6 times, we believe we can go up to that level, which is a very comfortable level, given the strong parentage support as well and the capital available with the group. And in terms of the listing plan, so as of now, we don't have any listing plan, but definitely at a longer date, once we have demonstrate next 3-4 years of growth, definitely we would look at that stage how to go about the listing of this company.
Okay. One more question. So, next year, when the credit cost is around 1%, and your asset base expands, so leverage will go up marginally, that should mean possibly double-digit ROE for the housing finance business?
Double-digit ROE.
Yeah, it's already close to that. So that will translate into a double-digit ROE, yeah, because you'll have a 2.5% plus ROA, 2.5 to 3% ROA. That is also ex assignments. If you have assignment, then definitely you'll have a higher ROA. So it will translate into a 2-digit ROE in the next year.
Okay. Thank you and all the best.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Shali Brada Shah for his closing comments. Over to you, sir.
Hi everyone. On behalf of Motilal Oswal Financial Services, I would like to thank every participant for attending the Q3 FY22 Concall. In case of any further queries, please do get in touch with me or our investor relations desk. Thank you and have a good day.
Thank you very much. On behalf of Motilal Oswal Financial Services, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.